I think there's a place for us collectively as part of this institution to sometimes sit back and think about the big picture. Because the big picture is every bit as important as actually trying to figure out exactly how the EZ could or could not break up. So we have to look at the particulars in our industry, but every now and then we have to step back and think about our industry. And why should we think about our industry, and why should we think about the models that we use and the way that we look at the world? Well, it's simple, because 2008 happened. And actually before that, we had 2000. And before that, we had 98. And before, I mean, you can go back, and Volcker is on record as saying that in his view, partly because of the use of computerization, there's an acceleration in world crises. And the 300 Club was formed from a bunch of senior CIOs, myself accepted, the other guys are senior, who are clever, myself accepted, who wanted to start questioning absolute truths that we take to be the truth. And one of the truths that I'm going to use to hang my talk on today is a truth that we all accept, that somehow today we are more sophisticated and therefore better able to understand and utilize risk than people have been ever before. And somewhere at the back of our mind, there is this dream of El Dorado. So this is not medieval, but this is going to the early English era. There used to be a gentleman who lived in London by the name of Jack Dee. And Dr. Dee was in fact an alchemist. He worked for the Queen, so he was a good alchemist. And he dreamt about a way of having high returns with no risk. It was converting lead into gold. And we think that the days of Dee are over, but they're not, because that dream somehow is still out there. And it's based on several misconceptions, which I will try to raise. Now, I'm not saying I'm right, but I'd like you to think about them. One of the talks in the conference here in Prague is about behavioral finance. And I want you to think about behavioral finance and psychology and anthropology, which Anne worked at, when you think about markets and how you think. And the starting block is start to question with me what truths we think are true and whether they are true or not. And I'll share one that surprised me. So I sort of assume that we live in a more globalized world than ever before. I mean, do other people share this view? Yes? No? Yes? Yes? Yeah, we all share that? We're wrong. I found out, in fact, if you go back to 1902, effectively, if you look at blocks, trading blocks, controlled by single governments, you couldn't count more than 35 to 40 at the max. At the max. So in fact, trade was quite easy to conduct. And the markets were quite easy to understand because the number of players were limited. And conflict was quite easy to control because with 35 players, of whom probably about 7 were major and the rest were minor, it was easy to control. Today we have well over 200 separate sovereign players. It's a lot more complicated. And I'd argue slightly less global. Before we start the talk, look, I'm an old-fashioned guy. I've invested in equities most of my life. I don't understand this new stuff called derivatives and stuff like that. But who can tell me where derivatives are traded today? Well, at least they were up to 5 years ago. And they've been traded continuously for 1,000 years. Any takers? Downtown Cairo. For 1,000 years in downtown Cairo, there is a square next to a mosque called Sidi al-Hussein, up to 5 years ago, which is when I went there. They might have closed it with the revolution, I don't know, where farmers went and sold future crops. There's contracts for futures, right? So these guys in Galabias were trading contracts for futures. More than that, they tranched risk. They wrap them in bundles, they tranche different years with different crops, and they sell them to each other. And you know what? They take margins. So it's not new. Who knows where the idea of using momentum as a way of studying market originated? Any takers? Japan, Edo rice farmers. It was, we all believe in momentum. We all look at charts, right? I don't know if charts work or not. It works because we all look at charts. But the truth is that the first person to look at charts says, look at charts, it can work, was an Edo Japanese farmer. And this is an important point that I want you to think about, which is, we are the market. So what we think is true is true. If we think a chart that has a double head and shoulders is a downward signal, it is a downward signal. And until that Japanese trader actually looked at charts and said to all his colleagues in Edo, look at the charts, nobody thought that was a signal at all. So it comes back to behavioral finance. So rather than talk about alternatives, let's talk about how basic investment is. And I want us to think like a caveman. Why don't I say medieval? Because people get turned off by the thing of medieval. Now, you know, what is it that cavemen were after, or early man? Early man was after survival. Survival essentially is a return that is commensurate with the risk that you're taking. Nothing has changed. We're looking for a return that will pay for the future survival income of the pension funds for whom we invest. This has not changed. It is exactly the same. He defined risk, if one could speak to him, and Ugg spoke back to us, he'd say to you, risk is either A, I don't eat, or risk is I die. Risk, and I want to come back, has been warped. I am going to argue in this talk that the concept of risk that you use in your modality and understanding how you do your asset allocation is slightly different from what it should be. Because risk ultimately is total loss. Risk is not relative loss. Risk is not volatility. Risk is when you lose things. That is risk. Ugg understood it. We sort of should understand it too. And then the final point is, what made us superior as beings that stood up on the savannah, and my apologies for any creationists in the room, but what made us superior beings who stood up on the savannah and walked out of the savannah into the rest of the world was not just that we stood up on hind legs and our brains grew bigger, but we learned to cooperate with each other. And the one element that defines this industry is that we have failed to cooperate. So we're approaching the way that we build our asset allocation and our structures and our investments in a way that is antagonistic and adversarial. And so we, the experts, are trying, and I'm going to be very, oh God, it's on camera. All right, never mind. We are trying to leg over our clients by basically massaging the facts to sell them a product we want to. The regulator knows that, so they're trying to stop us, but they have an interest, and I'm going to come back to that because, of course, they need money from our clients too. And our poor clients are losing out, and they're getting angry at us, and they're telling the government, God, you've got to do something about this. Now, Ugg, back in the savannah, worked out this is no way to advance. And that's where we have to go back to, where we actually cooperate, and it's less adversarial, and it's more cooperative, and you can call it fiduciary management, and you can call it long-term value, and you can call it responsible asset management, which is the name we give it at Hermes, but it's the same thing. It's cooperating with your client, and cooperating with the regulator, and cooperating with each other, sharing information with each other, not treating each other as adversaries for the good of the whole community, because if we don't do that, then some of us are going to reinvent something that's like CDS, and the other guy who knows that CDS is just reinsurance with no asset base is not going to say anything, and then we're going to have another crisis. And then we're all going to be out of a job, and that's bad because point one for us is lost, because our survival is at stake. Now, how sophisticated are our alternative investment capabilities today? And I don't think they're really that sophisticated at all. I mean, the oldest alternative investment that modern man has used is, in fact, real estate. Well, yeah. I mean, real estate has been there for a while. And real estate as the first alternative diversifier or investment has been on for a long time. And people make a lot of noise about real estate and whether it's good or it's bad. And this is a new theme that I want to introduce, data. We all use models. But actually, unlike real mathematicians and real scientists, we have a paucity of data. So we build very complex models with very little data. Now, it happens that in real estate is the only asset class where we have absolutely accurate data, more than gilts, even UK gilts, more than stocks. Because there happens to be a series of houses in Amsterdam in a street called the Haningracht, which was built in the 17th century and it still stands. And that still remains a prime residential street. So we can follow the price movements of that asset class as the first and the longest and the most observed asset class in the alternative sphere. And what do we observe? We observe that over the years, you could have made fortunes and you could have lost fortunes. And it was tied to the economy and, as the speech just before lunch said, it was tied to politics. And I'm going to come back to politics. But actually, net-net, from then to now, you kind of made inflation. And inflation is good, because all of us sitting in this room, and I'm looking at you, and pretty much all of you are my generation or younger. I mean, I'm trying to make myself look younger here than I really am. You think markets go up. But if I were to show you, and I haven't brought the charts, I were to show you the long-term charts of two markets, the UK gilt market and the UK stock market from 1902 to the present, you will see that, in fact, the big surge happened at the beginning of the Reagan-Thatcher era. And there is a reason for that, which is partly that the political pressure of the Cold War was lifted, partly because the banking system was made easier, therefore there was credit pumped into the system. So we all think that high returns is normal. Before that, returns that were inflation plus 1 or 2% actually were thought to be wow. And that then follows something that Anne feels passionately about. What do we mean by alpha? Because we think alpha is plus 5, 6, 10%, right? Great. Go down to the casino downstairs and gamble, because that's the only way you can make it without risk. The second element is commodities. They're not new. We've been investing in commodities for a long time. Food and fire is commodities, and it rises and it goes and it comes, and people play the commodity market. And there's a moral question about whether we should speculate on commodities or not. But think again about commodities and food and fire and control of commodities. The fact is they're so embroiled in politics that we sometimes forget they're embroiled in politics. We all know that oil is tied into the politics of the Middle East. But I would argue that even the demand out of China is effectively a political demand at the end of the day. Because China's economic will is simply a reflection of its political will. So if you want to think about asset allocating to an alternative that includes something like commodities, it is not good enough that you understand the economic cycle. And it's not good enough that you understand the volatility of the economy as it relates to basic economies. And it's not good enough if you go out and you figure out what the harvests are going to be like in Canada, because then you can work out what the harvest is going to look like. Because what's going to move it is going to be, to a large extent, politics. And I'm not talking about just the politics of the Middle East and whether what happens in Syria or Egypt. I'm talking about wider politics. The demand that's happening out of China, I repeat, is interesting. So let me posit this to you. It could be that in 1992, somehow a light went bing above the People's Communist Party in Beijing, and they said, my God, we really, really love the Americans. We want to be like the Americans. The Western model is the absolutely greatest model in the whole world, and we don't believe in Marxist-Leninism, and Chairman Mao was a complete plonker, and we want to be Western capitalists, and we want to grow a middle class, and we want to build a middle-class democracy. That is a possibility. Or another possibility is 1992, the Soviet Union collapses, despite its superiority in arms, because they could not keep up with the spend on Star Wars, and the People's Communist Party goes, oh God, we better build the economy. Now, you take your pick. I know which one I choose. And that means that the demand for commodities is to a large extent dependent on their politics, not the economics. And then the tools of the trade, corporations. I mean, you know, all derivative instruments ultimately are either based on cash, on an underlying commodity, or on shares. That's it. So if you strip it down to the basics, you come down to the basics of it. It's not as complicated as we make it sound. And therefore, the same tools that allowed our forebears, for our ancestors, to actually work in the market and understand the risk in the market are the same that we should be using also. And we should remember that some of the greatest humans were some of the most cynical humans. And that's Mark Twain, for those of you who can't recognize the picture. And I love the first one because, of course, he was an investor in the market. And that statement is half joking, but actually he's half being serious about somebody trying to sell him an investment in land. Buy land, they're not making it anymore. That sounds ridiculous, doesn't it? That's a lot less sophisticated and a lot more ridiculous than CDS's work, because in fact the risk is defrayed in the market. So ultimately nobody's carrying the risk because it's floating there in the sky somewhere with no underlying asset to pay it back. Yeah? And the third point is advertising. And our industry is full of advertising. And that's where we're going to come to the crux of this talk, because our industry advertises that it can deliver D. Do you remember D, this alchemist? Our industry is based on the belief and an advertisement that we are better at alchemy than D was. We tell pensioners, it doesn't matter what your liabilities are. We have alpha, and because we have alpha, we can deliver to you risk-adjusted, higher returns with lower risk, because we have understood risk. And we understood risk because effectively, and this is where the key comes, we have mastered the financial and economic markets in the same way that we have mastered physics. every single model that's used by every single asset management house, every single model that's used by every investment bank, or indeed by every consultant, is based on this belief that you can work out what's going to happen through a model that tells you exactly what's going to happen. But there have been some changes, and actually the changes have added to the complexity of our problem. And here are the changes that have added to the complexity. Life expectancy was until very recently very short. It's now very long, and there is a problem about it being very long. And the problem, in fact, relates in two ways. There's a problem as far as our end clients are concerned, the pensioners, because they're living much, much longer than they used to before. And that means liability modeling them is becoming a lot more complicated than it was. And actually, a lot of the way that our business was built, and remember, our business was built in the 40s and 50s when people did not live to be 70 and 80, did not really assume that a bunch of your pensioners are going to be living for long periods, except in growing countries like Canada, and where they're still young and growing, and in emerging markets. There's another problem about long time horizon and the fact that we're living longer, and that's to do with governments. Over the last 50 years, do you remember I said there's this rise that happened in the Reagan-Thatcher period? Between 1945 to 1979, there was a period of unprecedented stability, precisely because there were two powers that were at each other's throat and could destroy the world at the same time. And in that unprecedented period of stability, governments entered into a kind of contract with their citizens, specifically in Europe, but to some degree in the United States, of providing certain services and of providing certain minimums to do with health, to do with governance, to do with care, particularly social care, particularly in Europe. Again, I repeat, in the talk earlier this morning, and I'm only using it because it's fresh in my mind and because the phrases are very European. He talked about brutish cuts as opposed to normal cuts. Right? The idea that there are brutish cuts and normal cuts are all based on this concord. And the problem with that is that actually governments, as Mrs. Thatcher so many years ago once said to a reporter, have no money. The money they have is simply the money they tax us to pay for, and governments today are in debt. And if you were to do a graph, which I haven't done for you because I didn't want to scare anybody, of adding up the gross debt that each and every one of you knows of the countries, 92% in the United States, almost 100% in Southern Europe, 80 to 90% in core Northern Europe. If you were to add these debt numbers to the liabilities that they have, that's the health liabilities, the social services liabilities, even the defense liabilities, you would end up at numbers that says there's a problem, because in the United States they come to roughly 5 times GDP. So if you were to go to a bank today, whichever country you happen to live in, and walk into the bank and say to the banker, Mr. Bank Manager, I earn $50,000 or $100,000 a year, and I'd like you to lend me 5 times my earnings now, please, to go and buy a house. Probably, unless it was Royal Bank of Scotland in the bad old days, he'll tell you to go take a running jump. Probably. And yet, that's exactly what we're doing with the United States. We're buying their paper, and it's to do with longevity. And so something is going to give, brutish or not brutish. When you think about it, something is going to give. We were always fashionable humans. We ate seasonally. I grew up eating seasonally. I'm an immigrant, so I was used to it. We now invest fashionably. So in the 50s, there was the cult of the equities. I grew up in the 80s in the city. That was the cult of absolute equities. Then we went into the cult of, let's go into fixed income. Then we went into the cult of hedge funds. Then we went into the cult of alternatives. Then we went into the cult of LDIs. We like fashions. We like fashions. And the problem with fashions is we think that fashions survive. And what we do is when we analyze fashions, we then look at the data, and I'm going back to this idea I posited at the beginning of the talk, the paucity of data, and we believe our data is absolute and therefore can be used with accuracy when it cannot. And we make decisions based on that, not realizing that actually it's simply a function of a seasonality. There are seasons in which certain investment classes work. There are seasons in which certain products work. There was a time in which buying equity was a no-brainer. And essentially what you were buying was the beta. And that's why benchmarking was invented. And of course now we're saying, well, benchmarking is bad, and we have to go to smart benchmarking, but that's something else, and smart beta. But it was simply trying to distinguish between skill and people who followed the fashion. Then came the noughties, and in the noughties there was this great fashion for hedge funds. Somehow these were the guys who are going to make our clients money. And it was better because, and it was based on actually a perfectly reasonable academic concept, which is, it has been shown by several academics in the States that if you have high active share, very different from the index, you have a higher propensity to beat the benchmark over the long term, which if you think about it sort of makes sense. And long shorts double their exposure or triple if they could to high active share. So it made sense. We now have new ways of making money by buying alternatives and actually using synthetics to do it. It's just fashion. And all the models that we look at work because within the season, they sort of work. And then here is the problem. We've gone to fiat money, and fiat money is really scary because it doesn't mean anything. It really doesn't mean anything. I mean, it's an amazing trick. You know, the Chinese invented fiat money mainly because the emperor did not want to give out his silver. So he wanted to trick people to work for a piece of paper in which he said, this is worth 10 pieces of silver. The Muslim empire, which is a great trading empire, figured out that's really, really good. That's where you get the word check from. It's from the Muslim word sak, right? And then the Europeans looked at it and said, wow, this is really great. But there's a real problem because at this stage, you have governments that are indebted. And I'm going to come back to that when we talk about cooperating as a unit. You have governments that are indebted, and we have to believe that the money is worth something. Because, of course, governments never, ever fail. Because, of course, if you buy US treasuries, it's safe. Because that is, oh yes, what is the Markowitz theory? It says risk-free rate of return. That's a rate of return that is entirely without risk. Well, at least as far as the major governments are concerned, because the theory says that. And for a theory to work, it has to apply absolutely. By the way, the exception proves the rule is a misinterpretation of the Latin. The Latin says, for the record, the lack of exception proves the rule, which is exactly the meter by which physics is judged by, right? But the theory was that you could build investment portfolios and build efficient frontiers on the basis that there's a base which is a risk-free return. And the book that came out just after the crisis, this time it's different, shows undoubtedly that every single major country, actually every single country bar one, I think it's Norway, has defaulted, including the United States. So that is a problem because we're lending to governments, we use their money for finance, we're building our models based on this idea that our base is a risk-free rate of return because we sort of think in all probability it is, sort of, you know, I hope, you know, really, maybe. By the way, just in case you think I'm being over-dramatic about this, the British Empire reached its peak roughly in 1900 before it starts to decline. So in the 1920s, the British Empire was not in decline. It was not. It just was going through a very tough economic period where GDP was contracting and debts were high and it had a stock market crash. And what it did was it took a bond called the War Loan Bond, which was issued to finance the First World War. And it unilaterally cut the coupon and extended the repayment period. And that was the most powerful nation in the world at the time. But of course, this can never happen in our time with anybody else, and no Southern European country will ever default. And that then leads to superstition, and superstition is old. We humans, if you listen to behavioral therapists, we humans want to see patterns. We're designed genetically to see patterns. There's a lot of work that's shown that it's in our genome sequence to try to identify patterns because actually it's beneficial to us in the long term. Now, Ugg identified patterns. Today, well, in the 70s, there was a famous book called Chariots of the Gods that said that this is proof conclusive that, that flying saucers came to visit Earth in the beginning. I think it's just proof conclusive that people like patterns. And this one is another proof conclusive that people really, really like patterns. And it's interesting, I'm a historian, so I like to look at it's not saying that the whole model is wrong, but I like to look at the origin of things because it underlines every single risk model, every single asset allocation model that you built is built on that. And the feeling that you can build an efficient frontier, you can understand the risk, and it's based on risk-free return and an idea of a risk premium. Well, let me give you some background, which is historical background. Markowitz started working at this not in Chicago. In fact, he started in Chicago, he went on to Rand. By the way, Rand was a military, well, not military, but was a defense institute, a defense research institute. And they used a program called algorithmics to try to figure out where the Russian submarines would disperse to once they came out of the Baltics, right? Markowitz couldn't find any other program to use because computers were not that common that way, so he used algorithmics, which is, by the way, why we look at algo today. But let's forget about that. The point about it is that when Markowitz was working, he was working at a time when people had begun to think, and particularly the Chicago school, that they really understood how economies worked. Put this in context of human advancement. It was a time in which we had completely conquered physics. We'd essentially started the beginning of the road to spaceflight. We understood the physical world, and the economists believed that the world around us, the world of finance, the world of economics, must obey the same kind of rules that if we only found them and understood them, we'd believe that. And Markowitz just took it one step further and said that also must apply to investment, because investment can't be just speculation, right? It must be something more. And what he did was fascinating. He actually sent out letters to brokers in New York as a PhD student, asking them to tell him, in hindsight, what returns they expected for the stocks that they recommended a month before. That was his database. And then he averaged it out, and that was how he came out with the risk return. And then his computer guy said to him, I cannot run all these correlations together. This is when computers occupied a room that's this big. I need to have a common factor. Let's call that common factor beta. It doesn't mean it's wrong. It just means be aware of where it came from. And it has its problems. But at that time, the idea that the United States, the biggest economic power on the rise, should ever default on its treasuries was unthinkable. And it's highly improbable today. But the problem is, if you build a theory, it's got to apply to all governments. And I think there's no one in this room who doesn't think there's a possibility that, say, the Greek government might default. Maybe even the Spanish government, right? Maybe even the British government. And therefore, you have to be careful about modality. And it's one of the main things. The 300 Club stands for several things. We want the system to be better. We want people to cooperate with each other as regulators and investors and clients. But we also want more simplicity in the system. And we want not to stop using models, but to say to our clients, the models are not infallible. We understand their background. And the biggest problem with the Markowitz model was it ignored the human factor. And in fact, that was pointed out to him by a guy from the psychology school in Chicago. He said to him, Markowitz, he said, Professor Markowitz, look, there's two problems. You need a perfect computer, and you need a perfect man, and perfect man can never exist. And the way that we behave as a herd is well documented. And a lot of our decisions are well documented. We see patterns we want to see. We behave in a way we want to behave. And it's fine, and that's our job, and we will build the models, and we are trying to do something for our clients. But for God's sake, let's not say to our clients, this is absolutely it. This is going to work. Of course, there's risk in there, and it's not always going to work. And so let's go about risk. See, originally, early man understood risk meant when you lose everything, either when you lose absolutely everything or when you die. That's sort of risk, total loss. Homo sapien financium, a modern financial man, thinks that actually risk is about volatility. It's whether something goes up or down 10%. That's not risk, that's just volatility. And so, VAR has come into vogue, maybe not so much in Europe, but I'll tell you, in the United Kingdom, the regulator is asking pension schemes to use VAR. And I'm just a silly historian, but I sit there and I think a system that was designed to report to the chief executive officer of JP Morgan what his trading book will do in any 1 week, assuming, and that's important, 3 underlines on the assuming no major market moves on the Dow. How the hell does that become the standard by which we judge our long-term liability for our pension schemes? I mean, I must be missing something. And what the hell does the numbers mean? I sit on an investment committee and they come say to the trustees, if this happens, then VAR is going to be 6 billion. And they go, does that mean 6 billion is all you're going to lose? No, it doesn't. Because every now and then we have black swan events and we have 27 standard deviation events. No, we don't. It just means we don't have data. That's all it is. I mean, maths doesn't work like that, right? It just means you don't have the data. You haven't got a clue what's going on. And we have to think that in reality, risk is loss. Risk is loss. You don't get your money back. Look, all investment, whatever it is, alternative or traditional, all asset allocation, all liability matching comes down to one thing and one thing only. You have a store of value. Remember the apple at the beginning in the chart, store of value? You have a store of value, your store of value. You, or rather your client, the investor, wants that back. So the first thing is he wants security, or she wants security of that. Now that means adjusted for inflation, because we have inflation now. And then he wants something in return for the fact that you've had the apple with you for 20 years. And hopefully he wants to get more of that back than we do as an industry, but we'll come back to that later. And so we have to start factoring in lots of things. It's not about VAR, it's not about tracking error, it's not even about inflation, it's partly about politics. Politics used to be a major part of investment decision making. Huge part. And for 50 years, it stopped being that. But my argument is we've gone back. By the way, just in case you doubt me and you think politics is not, who knows how the Rothschilds made their money? So you know. They made their money by exploiting the political uncertainty surrounding the events of the year 1815. They also manipulated the markets a little bit. And they had insider information, but that's okay. The fact is that it was about political turmoil. It's not that they were whiz-bang investors. They weren't that good. They just took a risk that the British government would win, having told the market that the British government had lost, of course, having known that they'd won the Battle of Waterloo and therefore cleaned up. But that was okay in those days. Regulation allowed it. And political risk, in the talks here today, when you talk about the European Union, my friends, we are no longer in the realm of economics. There is nothing economical about whether the Eurozone stays together or leaves. It's a purely political decision. The European Union came to be as a way of negating the political tension that was there in Europe for 300 years after the Second World War. And that's why the apparatchiks who run it are not bad people, actually. They might be slightly weird, but they're not bad. They're trying to keep this union together because they're afraid, as the previous speaker in fact said before lunch, they're afraid that if we go back to economies fighting with each other, in fact, that's more political instability. And you go back to what I said to you right at the beginning. There was a time in 1900 when there were 35 economic blocs in the world. That's it, 35 sovereign nations. Because everybody else, of course, including me and people like me with my skin color, were, of course, occupied by somebody else who looked a little bit different. But that's okay, single blocks. Nowadays, we have 198 nations. And the idea that we're going to rub along during a recession and a massive crisis, and that does not lead to political tensions, is nonsense. Of course it is. And so political risk has to be factored into your models as well. So what can we learn about risk? As investors, we differentiate between two things. There are some things you can do something about, and there are some things you can't do anything about. What you can't do anything about is the risk that's there, that's going to hit you. You can try to mitigate for it, but ultimately it will always get you. We chose a cobra. I mean, I like snakes, but cobras are scary things. And when we lived on the savannah all these years ago, cobras were really deadly. They hid, they occasionally bit us, and we died. That was something that we as a species could do very little about. What we should have been able to do more about, and occasionally we didn't, is patterns. We had migratory patterns. And we assumed, and we taught others in our tribe, that these migratory patterns worked, and they gave us access to the best water wells, and the best food, and the best hunting, and that was the best risk return achievable, and it was pretty safe. If you look at the modern era, we still have the same two risks. It's just called two different things. We have fraud. I mean, Madoff is the name that comes to mind, but there are other frauds. You can't always, I mean, you can try to mitigate against fraud, but the truth is that for our clients, there will be fraudsters out there, they will sell them the Eldorado dream, and they can't mitigate against that. But what we should be able to help our clients mitigate against is an understanding that patterns only repeat for a period and then fail because they're seasonal and because we don't have enough data. And that's long-term capital management. If you remember, somewhere around here, just before it's collapsed, just about here, just where the dot is, I believe, and this was done by a bunch of Nobel laureates, so it's really clever mathematicians, right? And it was an amazing arbitrage system. It was absolutely perfect. It was fail-safe. It was going to make money with no risk whatsoever. And some idiot like me said to one of them, "Excuse me, how does that work?" And he said, "Well, it's because there are idiots like you that will always make money." And of course, they collapsed the next day, which is kudos for you. But the point is that we, of course, you can build the model, and of course you can have an asset allocation, and of course you can use your methodology and your modality, but be aware it's not infallible. It's like him. Seasonality will change because you don't have perfect data. It's not saying that Markowitz is complete rubbish, but it's saying understand the limits. It's not saying risk models are rubbish. Understand the limits. Doing scenario analysis is great, but it doesn't tell you much. Because history, my friends, echoes. It doesn't repeat itself. We are not going to have another 2008, not exactly the same way. So running a scenario of what my portfolio is going to do in 2008, yeah, okay, it's interesting, but it doesn't tell me much. Running a mathematical model in which if it goes outside, then I lose more money, I say 27 standard deviation event is just simply saying my model was wrong. It doesn't mean I don't build one. It just means, like my ancestor on the savannah, I've got to think, you know what, maybe this year the lake would have dried up. What's my backup plan? Because lakes do dry up. Let's talk about regulation. And this is the cooperation. See, originally, when we were tribes, we sort of cooperated because one person endangering this tribe endangered existence. Now, unless we're talking about fraud, that does not happen. We do not punish people who promise more than they can deliver. That's the first thing, just promise more than they can deliver. We have built a system whereby people take more out of it than they put in. I have absolutely no issue with a certain chief of a major bank in the United Kingdom who's just resigned, having made in his career as head of his investment banking arm £200 million. I have no problem with that. What I have a problem with is that he had no downside risk. Downside risk for him is not to walk away with just £200 in the bank, right? That's not downside risk, sorry. Downside risk is to lose the £200 million a bit more. That's downside risk. And that's something that originally we understood and we no longer understand. Let me come to the modern era. Do you know, in the 1920s in the United Kingdom, up to the 1920s, investment bankers, merchant bankers were part of unlimited liability companies. You're all far too young to remember this, but if those of you who are old enough to remember, there's a wonderful 1960s kids movie in English that's called Mary Poppins. And in Mary Poppins, the father is essentially a merchant banker. But he had unlimited personal liability. That's why he tried to commit suicide when he thought that the business had failed. We have to build a system where the risk reward for us, the participants, are right. Because otherwise, our clients are losing. The 2 and 20 model, I mean, it was brilliant, right? It was brilliant. So the client paid you 2% on the assets. And then if you made him money, well, you made 20%. And then the next year you blew up. And oh my God, well, you were aligned because you got nothing. Excuse me? You just got 20% and 2% and 2%. No, you did not get anything. You got 24%, sorry. The client got nothing. And that is what's wrong. The regulation has to be cohesive. And you can't expect government to come and regulate us because the fact is the smart people are, no offense to regulators, in this room. They're not sitting in Brussels writing regulations. So every time they put a regulation in place, actually smart people in this room find a way of going around it to sell more product. So what we should do is get together and sit down, regulators and us and the clients, and figure out a way of having the best system forward. And by the way, the regulators are in fact partisan. I mean, again, you could take the view that Solvency II is a perfectly rational way of dealing with the volatility following 2008. I agree with that view. It has an unintended consequence, which is it diverts the pool of savings in Europe, which is in insurance companies, away from the risk capital of equity, which technically Europe needs in the long term, towards government debt, which governments need in the short term. But I'm sure the regulator was doing it because it's completely nonpartisan. I'm absolutely certain of that. But we have to all work together. And then we come to the ultimate question of fairness, which is how do we price our products? Now, we could do it any way you like. We can do it on a cost-plus basis. That's the fiduciary model in Holland. My colleague in the 300, Lars Denska, who's the CIO of Kempen in the Netherlands, has just published a paper for the 300 today about true alignment with the clients and the agency problem. A cost-plus is very transparent. But nobody likes that. We can let the market forces decide. If I've got a really super-duper alternative, really complicated product, you know what, you're going to have to pay me 1 and 20, 2 and 20, whatever it is. Or if it is just a boring product, you're going to pay me 50 basis points, whatever it is. Or we can do whatever we can get away with. And for a long time, I would suggest that this industry has gone for number 3. It priced products at the price it thought it could get away with. And all this talk about long-termism and alignment with clients is, forgive me, patently not true. It's just patently not true. There's been a lot of work done, particularly for retail clients, a lot of mathematical work that's been done that shows you that that's not patently true. And so we've got to think again, if we're going to survive, go back to survival, the survival of us as humanity, survival of the financial system, and survival of us as an industry. If this industry is going to survive, this industry has got to rethink how it prices, what it does for its clients. So what are my conclusions before I open it up for questions? Investment is actually very, very old. I was flippant and I talked about cavemen. But I wasn't flippant when I talked about the derivatives market in Cairo. I wasn't being flippant when I talked about the rice traders in Edo in 16th century Japan. I was being dead serious. People have been investing for a very, very, very long time. Contract for futures is actually mentioned in the Old Testament, if you're interested. So there's nothing new about this. And by the way, the guy selling it cheated, but that's by the by. There's nothing new about what we do. Well, we've got to recognize that it's not that new. And what does that mean? It means we have to recognize we're not smarter than we were. We have tools, we keep on reshaping the tools, but we're not smarter. And we have to apply common sense. The reason that I know that physics works, I mean, I don't know that physics works because I'm too stupid, but I can look up that physics works because people can show me in repeatable experiments that the laws of Newtonian physics are immutable. And please, don't somebody stand up and say, what about quantum mechanics? I'm aware of quantum mechanics. But Newtonian physics sort of works. The reason I came here on A320 is it because it obeys Newtonian physics. I don't know about you, I will not step on a 320 that's based on the financial theory which central banks use and which financial analysts use and which asset managers use because it's not testable, it's not repeatable, and it's not absolute over all times. So you can fly on that plane, I won't. And if I do, I will understand the risk that I'm taking, and that's the point. Common sense. Apply common sense. I mean, you know, if it looks too good to be true, it is. That was the whole point about LTCM. That's all it is. The third point is important. We really, really, really misunderstand risk. And I've offended everybody. I've offended colleagues in the asset management industry. I've offended governments. I've offended regulators. So let me offend the last group of people I have not offended today, my good friends, the consulting community. It's their fault. And the reason it's their fault collectively is because when people moved away from the old-fashioned way of doing things, which is trying to make real money, which is how Baring's pension scheme, which ran incredibly successfully from the 1780s all the way through to the 1960s used to be run, without diversifying its income. They invested oftentimes the whole pot in one single venture, sometimes 3 or 4. They applied common sense, they sort of tried to work it out. And then in the 1960s, they had consultants come in and they said to them, you know what, that's not the right way to do it because it doesn't look at efficient frontiers. And what that did was that we started to differentiate between beta and alpha. And the problem with differentiating between beta and alpha is we define beta, which is the benchmark, and then we start defining that risk effectively is the correlation to that benchmark. It's the volatility of that benchmark. Even today, when we're talking about LDI, and even today, when we're talking about long-term liability matching, we're still talking about deviations from a benchmark. That's nonsense. Risk is risk. Risk is when you lose something. And then the clock starts again. And that is one of the issues that we have. And finally, the reason that people pay us money, and this is, I think, where the problem started, and I'll finish my talk with this idea. What we do, I think, and I was saying this earlier, is a truly noble profession. Honestly. And if I did not think that, I wouldn't do it. We look after the future of the older generation. We take the money they have saved, and oftentimes they're blue collar and they're far poorer than we are, and they'll make less in a year than we oftentimes make in a month. We'll take those assets, we'll look after them, we'll nurture them, we'll try to preserve them and give them something slightly more than inflation, so that when they retire, not only do we meet the technical liability of the retirement, but hopefully give them something a little bit more. The problem with it is it's a very difficult skill set. It's not that there weren't investors, there were always investors. But sometime in the 70s and 80s, there grew this idea that you can industrialize investment, just like a Ford factory. And that was the beginning of the problem, because people started saying, well, if I'm going to industrialize it, I'm going to build models and I'm going to control it and it's going to grow up. And it doesn't work. And we have to recognize as an industry that there's a limit to how big we can be and in fact to how much skill there is. Because the skill set that exists among you is limited. And ultimately, investment is not difficult in the sense that it is simple. It's not a complex thing. Realizing whether your cash that you put in you're going to get back, adjusted for inflation in real terms or not, is not complex. It has lots of complex components. The economy, the market, the behavior of other market participants, politics, but it's not complex. That is not to say it's easy. And that's the problem with it. It is not complex, it's simple, but it's not easy. Thank you very much indeed.
Copyright 2012 CFA Institute. This program is designed to give accurate and authoritative information in regard to the subject matter covered. It is distributed with the understanding that CFA Institute is not engaged in rendering legal, accounting, tax, investment, or other expert advice. If legal advice or other expert assistance is required, the services of a competent professional should be sought.